Hello and welcome to this video on how inflation can shake up the Forex market and algorithmic trading strategies. What traders need to know. Inflation can have a significant impact on the Forex market and algorithmic trading strategies. Inflation refers to the increase in the price of goods and services over time, resulting in a decline in the purchasing power of a currency. This can have a number of effects on the Forex market and algorithmic strategies. Firstly, inflation can impact the value of a currency. When inflation rises, the value of a currency may decline, as the purchasing power of that currency decreases. This can impact Forex trading strategies, as traders may need to adjust their strategies to account for changes in currency values. For example, a trading algorithm that relies on identifying undervalued currencies may struggle to find profitable trades in a high inflation environment, as many currencies may be overvalued. When inflation rises, the value of a currency can decline for a few reasons. One reason is that inflation can erode the purchasing power of a currency, making it less attractive to investors. If a currency is expected to lose value over time due to inflation, investors may be less willing to hold that currency, leading to a decline in its value. Another reason is that inflation can lead to higher interest rates, which can make a currency more attractive to investors. When interest rates rise, investors may be more willing to hold a currency that offers higher returns, leading to an increase in its value. However, if inflation is rising faster than interest rates, the real value of the returns may still be declining, which can lead to a decline in the currency's value. In a high inflation environment, Forex trading strategies may need to be adjusted to account for changes in currency values. For example, a trading algorithm that relies on identifying undervalued currencies may struggle to find profitable trades if many currencies are overvalued due to inflation. Traders may need to adjust their strategies to account for changes in currency values and identify new opportunities for profitable trades. Moreover, inflation can impact different currencies differently. If one country experiences higher inflation than another, its currency may decline in value relative to the other country's currency. This can impact Forex trading strategies that rely on currency pairs and require a deep understanding of how different currencies are affected by inflation. Overall, inflation can have a significant impact on the value of a currency and Forex trading strategies. Traders and trading algorithms need to stay aware of changing market conditions and adjust their strategies accordingly to ensure continued profitability. Secondly, inflation can impact interest rates, which can have a significant impact on Forex trading strategies. Central banks may adjust interest rates in response to inflationary pressures, which can impact the value of a currency. A trading algorithm that relies on interest rate differentials may need to adjust its strategy to account for changes in interest rates. Additionally, inflation can impact the overall economic environment, leading to changes in government policies that can impact currency values. Interest rates are a critical factor in Forex trading strategies, as they can impact the relative value of different currencies. Central banks may adjust interest rates in response to inflationary pressures, which can have a significant impact on Forex markets. For example, if inflation is rising, a central bank may raise interest rates to try to slow down inflation. This can make the currency more attractive to investors, leading to an increase in its value relative to other currencies. A trading algorithm that relies on interest rate differentials may need to adjust its strategy to account for changes in interest rates. Interest rate differentials refer to the difference in interest rates between two countries. Forex traders may try to profit from these differentials by borrowing in a low interest rate currency and investing in a high interest rate currency. However, if interest rates change due to inflationary pressures, this strategy may become less profitable or even result in losses. Inflation can also impact the overall economic environment, leading to changes in government policies that can impact currency values. For example, if inflation is rising, a government may implement policies to try to slow down inflation, such as reducing government spending or raising taxes. These policies can impact economic growth, which can in turn impact the value of a currency. Moreover, inflation can impact the trade balance between two countries, which can impact the value of their currencies. If a country experiences high inflation, its exports may become more expensive relative to other countries, which can lead to a decline in demand for its exports. This can impact the country's trade balance and lead to a decline in the value of its currency relative to other currencies. In conclusion, inflation can have a significant impact on interest rates and government policies, which can in turn impact the value of currencies and forex trading strategies. Traders and trading algorithms need to stay aware of changing market conditions and adjust their strategies accordingly to ensure continued profitability. Thirdly, inflation can impact the volatility of the forex market. As currency values fluctuate more dramatically, trading algorithms may struggle to predict market movements and execute trades at favorable prices. This can lead to lower profitability for algorithmic trading strategies that rely on market stability. Volatility refers to the degree of price fluctuations in a currency pair. High volatility can make it difficult for trading algorithms to execute trades at favorable prices, which can lead to lower profitability for algorithmic trading strategies that rely on market stability. In a high inflation environment, currency values may fluctuate more dramatically as a result of changes in interest rates or government policies. This can make it more difficult for trading algorithms to predict market movements and execute trades at the desired price. As a result, traders may need to adjust their strategies to account for the increased volatility, which can impact profitability. Moreover, high volatility can also increase the risk associated with forex trading strategies. For example, a trading algorithm that relies on leverage may be riskier in a high volatility environment, as the increased price fluctuations can lead to larger losses. As a result, algorithmic traders may adjust their trading strategies to reduce risk exposure, which can impact profitability. In conclusion, inflation can impact the volatility of the forex market, which can make it more challenging for trading algorithms to execute trades at favorable prices. Traders and trading algorithms need to stay aware of changing market conditions and adjust their strategies accordingly to ensure continued profitability. Moreover, inflation can impact risk management strategies for forex trading algorithms. In a high inflation environment, certain types of trades may become riskier, leading traders to adjust their strategies to reduce exposure to these risks. This can impact profitability, as traders may need to be more conservative in their trading strategies to mitigate risks. In summary, inflation can have a significant impact on the forex market and algorithmic trading strategies. Traders and trading algorithms need to stay aware of changing market conditions and adjust their strategies accordingly to ensure continued profitability. Thanks for watching. If you enjoyed this video, please hit the like button and subscribe to our channel for more content like this.